Hello, I'm Marianne Deveni. Well, at the start of this year, expectations were all for the US to be the big winner. But surprisingly, we're seeing a different trend. Canada is actually outperforming the US, with the TSX up over 8% year to date versus about 2% for the S&P 500. So what's going on? Well, I'm asking Mike O'Brien, Managing Director of TD Asset Management and Portfolio Manager of the TD Canadian Equity and TD Canadian Blue Chip Equity Funds. So what happened? Why the disparity from what we expected?
Well, Marianne, I think a big portion of this is simply some catch-up. You know, Canada is playing a bit of catch-up here. I guess we have some short memories we might have forgotten, but the reality is the U.S. had an absolutely huge year last year. You know, U.S. equity markets were way over 30%. So I think part of it is just Canada making up some lost ground. The other part of it, if you break down the key pieces of the Canadian market, you know, the TSX, what you see is you get three big heavyweight sectors. So you have the banks, you have the materials space, and you have the energy space. For sector-specific reasons, all three of those sectors were out of favor last year. They were underloved, underowned. I think in each of those cases, you started to see investors come back to those spaces, and so the banks are quietly up about 6% so far this year, pretty good start. The materials have surprised a lot of people. They're up over 11%, and the best of them all has been the energy space, which is up over 15%. So if you get those three big heavyweights, you know, well over half the market pulling their weight, you get some pretty good returns.
And it really makes a big difference.
Oh, absolutely.
What about this year? What are you expecting going forward? It's still Canada?
I don't know if it's still Canada, and I think the right question to ask is still equities over bonds. Okay. You know, Canada, US, we like them both, to be honest. You know, I think there's good opportunities in both markets. I think we have to be a little bit patient here. You know, we've had good returns, not just for the last few months, but for the last couple of years. And you know, I think there's a bit of nervousness around the markets today, so people want to make sure that their bets are correct. So we might be in a bit of a pause here for a little while, but I think equities are still definitely the place to be, and within that universe, I'm seeing some good opportunities still in Canada.
Now, bond years have been very interesting. What's going on? We're seeing new lows almost, or at least historical lows, reaching again. Yeah.
Well, you know, this is the thing that's really perplexing people right now, is we have seen a really sharp dip in interest rates, especially the long rates. That wasn't in the playbook. That wasn't supposed to be happening right now. No. And so that spooked a few people. Now, I think I would say two things that I would, you know, 2 points I would make just in terms of trying to set the context here. The first is, you know, people are whipping up a lot of, you know, concern about what's happening today. But if we go back just 12 months, this time last year, bond yields were actually a lot lower than they are today. So, for example, you know, 10-year government bond yields in Canada are about 2.3%. This time last year, they were 1.7%. Basically from late 2010 through to you know, May of 2013, bond yields averaged about 2%. So we're actually a bit higher than we were over this last couple, you know, years. So that's the first point. The second thing I think is what we really have to do here is say, is the reason for this some sort of you know, an indication that the economy is coming off track? If this is some sort of doom and gloom, you know, harbinger that the economy is coming off the rails, you know, then we've all got some trouble. I don't think that's the case. So I think this is a good time to step back for a bit of a reality check and just say, okay, you know, from a fundamental level or a fundamental perspective, does it look like things are on track? And so if you've got a U.S. economy where payrolls, in other words, new jobs, have been growing at an average of about 200,000 jobs a month for the last 6 months, that's pretty good. U.S. housing starts are almost back to 1 million starts. Like in terms of the last 6 months, they've been about 1 million, which hasn't happened since before the crisis. Unemployment rate in the U.S. is down to 6.3%. So I look at all those, and I think this has more to do with technical and positioning issues. I don't think this is a screaming sign from the bond market to run for the hills.
So a little more maybe expectations were that it should just keep on going up, and there should be no change in, you know, in terms of bond yields, and maybe it's just doing a little dip.
And I think that's emblematic of this entire post-crisis recovery. It's been a slow, grinding process right from day one.
And a lot slower than people expected.
And a lot slower than people wanted. You know, so we all want it now, and sometimes we have to be a little patient. I think that's all that's happening.
Yeah, exactly. Now, you brought a couple of stocks for us. I thought Manulife was interesting because you said it kind of relates to bond yields. How does that look?
Well, I think this is an interesting opportunity, and again, it depends on where you stand on this, this conversation or this debate about, the outlook for bond yields, because Manulife is really the flip side of that coin. Manulife is one of those companies that are perceived to really benefit from an increase in interest rates. And so what you saw, over some rising optimism over the last year or so, Manulife and the other life insurers did very well. Conversely, so far this year, Manulife is actually down 3%, which shouldn't be a surprise given what bond yields have done. Our bet and the way we're positioning our portfolio is that the economy is on track, and we're gradually going to see this, increase in interest rates, this longer-term increase in interest rates resume, 2 years, 3 years, 5 years from now, which is how we think about things. I think it's a much higher probability bet that interest rates will be significantly higher than they are today as opposed to significantly lower. So, we look at these types of opportunities as buying opportunities for names like Manulife.
And you also mentioned CNQ, Canadian Natural Resources, in the energy sector. That seems to be a good space right now with everybody buying energy almost.
Yeah. Which, and again, that's just the polar opposite of where attitudes were last year. This time last year, you couldn't convince, you couldn't give away an energy stock or Canadian energy stock.
You almost had to wait for Warren Buffett to come in, and then everybody said, oh, it's okay now.
Warren made it all right for us. So, literally, the sentiment was so sour on, CNQ and the rest of the Canadian oil patch. So you've really seen people start to warm back up to the sector. You've had a really nice move in the stocks. CNQ is up about 40% over the last year, which begs the question, okay, is it all done? Is the story all over? But when I look at it, really, this is just the beginning. To me, this is the beginning of, this next leg for these guys, because CNQ is a $43 stock today. You go back 6 years ago to the beginning of the crisis, the middle of 2008, it was a $55 stock. And that's very representative of the rest of the oil patch, the rest of the Canadian energy space. So I think there's a lot of running room here. So when you look at the type of free cash flow that CNQ should be able to generate for the next 4, 5, 6 years, we think there's a lot of running room for this company.
So it still even hasn't gone back to where it was, which is interesting because a lot of companies have. And are
when you look at a lot of the other sectors, and especially these sectors that benefit from lower interest rates, like your telecom space and your pipelines and your utilities, much better performance from those groups. Maybe the best of that run is behind them, whereas now I think the thing to do is start looking for those sectors that have lagged and that could benefit from a different type of economic environment over the next 4 or 5 years.
Let's switch sectors and talk Magna. So consumer discretionary, been hurt a little bit, especially with the bad winter weather. Where's Magna going?
Well, I think Magna is a good example of one of these cyclical stocks, and we have to remember this is a cyclical stock, a cyclical industry, which has had a great run. And so now I think, again, as a portfolio manager, you need to step back and do a bit of a reality check. How much more juice is there in this story? And for some of Magna's peers, maybe the best days are behind us. But when I look at Magna, you've got great leverage to US and European auto recoveries, which is still pretty early in the cycle. You've got some self-help elements to the story where you look at Magna's profit margins in Europe have a lot of room to recover. And on top of that, you get a company that's generating about $1 billion a year of free cash flow with no debt, a lot of opportunities to increase dividends, buy back shares, make acquisitions. So that self-help component makes Magna the type of consumer discretionary name that has had a good run, but we still think there's some left.
And no debt. That's interesting. That's pretty rare, is it not?
Well, it's. I think they had a near-death experience in the 1990 recession, and that's stuck with them for a long, long time. But the new management team is looking to, I guess you would say, flex the muscles of the balance sheet a bit more than previous managements. And so I think they are going to be a little bit more active in returning capital to shareholders.
All right. Thank you very much, Mike.
You're welcome.
I've been joined by Mike O'Brien, Managing Director of TD Asset Management. Thanks for watching.